Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, guys. Well, it is CPI. I know when it's CPI day, I wake up and I can immediately hear in my head, you know, like the Inception trailer, you know? It's intense. All morning, going through my head, this is going to be an intense trade. In fact, the volatility index is predicting like a 2.5% volatility today. Some banks are saying that depending on how this number comes out, there could be a swing as much as 5%. So strap in and be very careful with your risk here, okay? Let's come into the charts to see what they're doing overnight yesterday. I want to point out, well, so I think that the big, we got to start with Bitcoin at first here, because that's the big mover this week, and it's been affecting all the other markets. And so yesterday, a little decline there. They did touch 1500. I was like, here comes 1500. They did touch it. Cool. After hours, because they were sinking when they announced that the FTX is not going to get the rescue from Binance. I need to minimize that. Okay, so then after hours, you're seeing people bidding the treasuries from that. So that's a little scary. That says to me there are some people out there that are losing money off of this. Somebody put some money where they shouldn't have put it. So that's what you see it going over there. ES yesterday, kind of a slow downturn, but flat overnight. Oil also in doldrums. Natural gas, gold and silver, they're still looking okay though. Like gold right there at 1700, silver above 21.2, and copper following the rest of the metals. And then we got to look at the dollar bouncing here between 110 and 111. Probably make that chart longer. I'm gonna do that later. So I am already here, man. I was able to get myself, I don't know what it was, the motivation or whatever, but I got showered real quickly. I had a full breakfast. I ate it all, and I was here in my seat before 7:20. I'm pretty proud of myself today. So let's hope that we get some good action. I'm really hoping that the numbers are going to be okay. That's all I can say is I hope the numbers are okay. US CPI, core CPI, where is it? Core CPI month over month, the expectation is 0.5. So that's the one that we really care about, 0.5 versus the previous leading of 0.6. And I'm actually seeing, so it's interesting to me that the consensus is 0.5 because both JP Morgan and Goldman Sachs think that it's going to be slightly under 0.5. So I think that's good. And I think that an inline core number is probably net good for the markets. But if the number is good or net good, I don't necessarily want to take a FOMO trade. Although it is possible that the 10-year sees 4% again if we get there. Now, of course, CPI is 0.6 or heaven forbid 0.5. Look out. These rates are going to come out with a vengeance. Are they having another hurricane, Uzi? I did not know. I haven't been following the weather as much as I should. When I was a kid, I loved to keep track of the weather. People would always ask me because I knew what the weather was gonna be. Oh, it's not bad. It's a fast mover and a category 1. Well, we got snow yesterday here in Utah, so that's good because we need it. We really need it. F your seasons. Well, seasons in Utah are a little interesting. It's not so like Missouri. Oh my gosh, when I lived there, it was like the summers are so bad and the winters are so bad. It's so bitter. Here in Utah, well, winter is usually okay. It's just kind of like dreary and just kind of cold. But in January, February, it can get pretty bitter. It gets foggy in the valley too. If you don't ski, then it sucks. But I'm hopeful that we're gonna get good skiing this year. I'm very hopeful. You're in leaf cell? Yeah, basically all the leaves have fallen. If this clears up, I mean, I don't think that it will be this weekend, but maybe next weekend, I might be able to go and rake the yard and put up the Christmas decorations. Two minutes. Yeah, I'm losing track of where I'm getting distracted here. We gotta focus. We got a CPI. I just got an email from ATAS saying that they have replay. Market replay built in. Okay, well, it's more than a minute out. And we are already seeing complete bulling. That means it's gonna be a big one. Time to breathe. Oh, mama. Spot three. Well, this is so crazy that I can't even enter orders. Wowzer, look at that move in the S&P 500. 100 points, 110 points instantly. Wow. That was something else. You might never see another one like that again. Holy shit. Wow. No, you can't trade it, man. It's too crazy. Man. See, look, like the DOMs here are like totally. My dime here is totally frozen. Rhythmic can't keep up. Rhythmic can't keep up, man. Oh yeah, gold really took a jump there. The Japanese yen really took a jump, man. Just everything is insane. Did you see that? I was like, let's put a limit order out. No, I don't think it even got sent. I don't think it even got sent. Switch to Continuum. No, I hate it. I had worse problems with them on this sort of a thing. It's okay. In an event like this, you wouldn't expect them to keep up. And it could be my computer, I suppose. Let's come over here. Like I'm getting like 10,000 messages per second here, so my CPU is handling it okay, actually. It really is that it's just not keeping up. That sucks, cause when I saw that, did you see there was some orders at 4.06? I clicked on it, I was like, no, there's no way that those are gonna get filled. I think that it rejected the order. Like, I clicked, but I don't think it sent it. So. Oh no, it's totally fucked up. Totally. No question about it. I mean, this is exactly why I have the update intervals on a lot of my charts and stuff down. No, it's not my machine. I'm pretty sure that Rhythmic can't push all of it to me. I should have moved to a trimmed down workspace with less instruments on it, because it's not that okay. It doesn't look to me that my system resources are not enough to keep up with this move. It's not pushing the data to me quickly enough. Rhythmic jammed, basically. So can we call it that? Morgan says his did too. But you're on Continuum. That's interesting. You know, I've had this kind of problem on both of them, so I think that it would be like a fallacy to sit down and say, well, that means Rhythmic can't cut it, I need to switch over, right? Really, if we would need to go to a much more expensive feed, like was that one IQ feed? Like, we could do IQ feed. Tobias says his Rhythmic is fine. But see, I think, oh my gosh, wait, what? What? So here's what I'm gonna do. I'm gonna disconnect NinjaTrader here. Okay. There we go. Yeah. I think the problem has a lot more, for me, has a lot more to do with the number of instruments that I have open. So. Now, what happened over here? Oh, wow. It took 5? Okay. Okay. Yeah, well, you have 11 DOMs up, but it could be like maybe, well, I mean, I think it has something to do with the connection and stuff, but okay. So I got filled there, got out of that trade. That made me a little bit nervous. Not gonna lie. Like, there's probably like way more in that trade if I decided to like sit through it and everything. But I'm just sitting here like, being in a situation where it's not keeping up is not what you want. So let's give it like 10 minutes for things to chill out a little bit. But you can see here now that I have unsubscribed from a bunch of data. But well, like, that's the other thing is like, I bet you here. Let's how should I do this? I should save my current workspace. Okay. Save. And then I'm going to close oil and the NASDAQ, right? And see, look, that's already better. Oh, live action here in Florida too? Man, okay, so like how far can the S&P 500 go here? Wait, how big of a move is this so far? I gotta close a bunch of windows and stuff that I just opened up to try and look at all of that. Okay, so let's connect back on NinjaTrader. I'm actually thinking on that one, maybe I should have like disabled everything except for ZN. Like, wow. Can you believe they filled me at 3.97. So this is $30 right there already. What a monster. What a monster. Okay, here we go. Wow. The NASDAQ is up 3.64%. Are you kidding me? Wow. This may be the biggest move up we ever see. This is gonna be like an all-time up-day record for a decade. Can you believe that? This is just absolutely insane action. What a move. We're gonna put the ES back up here. Okay, so now that we're done being amazed at how crazy of a move that was, let's go look at the report, because 0.3 is a little suspicious, don't you think? 0.3, a little suspicious. Okay. The consumer price index for all urban consumers rose 0.4% in October on a seasonally adjusted basis, the same increase as in September, the U.S. Bureau of Labor Statistics reported today. Over the last 12 months, the all items index increased 7.7% before seasonal adjustment. The index for shelter contributed over half of all the monthly all items increase, with the indexes for gasoline and food also increasing. The energy index increased 1.8% over the month as the gasoline index and electricity index rose, but the natural gas index decreased. The food index increased 0.6 over the month, with the food at home index rising 0.4. Okay, so when I'm looking through here, last month food was 0.8, was 0.6, so 0.6 is still pretty hot. Just keep in mind. Shelter was 0.8, so shelter was in line with the estimates. Like it's Goldman Sachs, they keep getting that estimate spot on, and I think that is basically like a known quantity. So where is the decreases coming from? Well, we saw a decrease negative 0.7% in apparel. Energy services, less energy services was 0.5. Medical care services came down. Okay, so it was as Goldman and JP Morgan predicted. Almost exactly, except for that they were saying like 0.45, not 0.4. We got 0.3. How did we get 0.3 core CPI? It looks like this apparel component was much bigger than we thought. Utility, gas service, well, energy was down I don't know. Core CPI month over month, spot 3. Not the headline. Don't look at the headline number. I mean, the headline number was 0.4, but well, since things kind of, the data kind of came back here for us, we are getting a little bit of a pullback, but it's still up towards the high. I think that they're probably going to have a hard time moving it up from here just because of the liquidity situation at the moment. But I don't think that's the high of the day, man. I really don't think that's even close to the high of the day. But at this point, what can you do other than to just sit here and hold your position, right? I'm gonna leave that sim one on. I don't think that I want to mess with this over here at the moment. This is this. So let me come back to my charts here. Oh, it is not actually the single largest day yet. There was back in June. That was a CPI number 2, wasn't it? Oh, no, wait. We want the largest down days. Yeah, June was a CPI day, and that was like that was the largest one that we've had, and that was to the upside. But here in yields, this is the single largest decrease in yields on my chart, at least. Okay, does this mean inflation is under control now? Not quite. So the danger with this move now is that the market is going to run with it, and I would not be trading against this today, okay? But we have to remember that there is still another key CPI report before the next Federal Reserve meeting in December. So we need to see that December number similarly low. And I'm a little bit suspicious of this number. To be honest, I'm a little suspicious of this number. So we need to see another number that's in line with this one in December before we would really see a meaningful change in policy from the Federal Reserve. Okay. But this is this is the best situation that you could get, right? This is the best situation that you could get. The jobs report, well, I mean, the combination of these two were really good, right? These were, it was really good. So I don't know. Like seeing the 10-year heading towards 3.9 now is kind of like, I don't know if I can make a call on that one. Obviously, the flows are going to continue here. We've had a jump of 50,000 contracts net through all of this. So I've always found that around 50 to 60 is like the upper bound of like a move in a day. So I don't think that I can just jump aboard this. Clearly, that trade that I had where I had gotten filled at 3.97, which was just kind of zany, I could have held and made 50, 60 bucks, which would have been amazing, right? But I don't think it was wise for me to keep that on, given the market volatility that we were getting. So, you know, it made me really nervous being in that on something that could move 10 basis points back down, right? Wow. I'm going to change the title of the video to I don't think this is actually the single largest update ever in the ES and NASDAQ. I think that there was a point back during COVID that was greater. Wasn't there a day back in COVID where we moved up like almost 10%? Is there a limit to how much an index can move in a yes? There are upside circuit breakers. Although I think that they are more generous than the short ones. I think that if they get to 15%, you hit the upside future circuit breaker, which has never happened and is unlikely to ever happen. But there is a limit up. Man, what's the most clickbaity way to put this in the title? It's not the single largest update ever. Best day of the year. Best day of the year after. Best day of the year after good CPI. That's what I'm going to put. If you guys can think of a better way to say that. Wow, we already have 31 viewers. Wow. Man. Well, it did finally turn back around. So aren't you know? This is exactly why I'm like, I can't get involved in it anymore. Do reverse psychology. Oh, this is so terrible. Oh my gosh. No. The worst day for bears. I know. Kyle's like, only 4 likes. Come on, guys. Well, it's okay. Man. So the question in my mind now is what do we do from here? Oh, by the way, did Bitcoin move on? Yes, they did. Okay, Bitcoin is at 16.3. Well, okay, so that's interesting. Shall we go onto Twitter and see if we can glean any more? Because I'm still a little bit like, how is it 0.3? Nick Timiros. I think it's Timiros. Ros. Yeah, R-A-O-S is Ros. That was good. Who knows? Probably still at 1 cent. Okay. Most of the gain in shelter came from lodging away from home. Owner's equivalent rent decelerated spot 6% in October from 0.8 in September, while the rent of primary residence decelerated 0.7% from 0.9% in September. Mohammed A. El Arian points to some easing in the cost of living pressures that hit the poor particularly hard, supports some easing of what has to be a very front-loaded Fed hiking cycle. Dun, 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 dun. Nick. Oh, and that was just him giving the overall number. Okay, so here's something else completely unrelated, but something that us and treasuries need to pay attention to. Regulators, Wall Street Journal News exclusive, regulators are looking to broaden trading in the immense $24 trillion market for U.S. Treasury securities, a potential power shift away from the small club of big banks that have dominated the market for decades, according to a forthcoming federal report. You know, I've been seeing a lot from Broker Tech and TradeWeb. I follow these guys on LinkedIn, and they've just been like building out their systems and working like super hard on all of those things. And it's really interesting that then that comes up. It was like they knew it was coming. But that's a big shift in the market. And that is something that we could take advantage of, and that I want to take advantage of. Oh, what's this? Also something from Bitcoin if I go back far enough. Alameda Research is opening shorts on Tether. And Bitfinex quotes that, saying, big if true, Sam's probably got dirt on the Tether fraud. He could have the last laugh. Oh, man. Oh, man, that would be so crazy. Ooh, okay. Forex Live posts a picture of Bank of Japan Governor Kuroda. He is very, very pleased with the print. Man. Okay, so I am not seeing a whole lot of like analysis of the number here yet publicly. That was everything that I just read there is all we got. Let's go over to Zero Hedge and see if they got anything interesting. Okay. Before the CPI print, the market was pricing a 30% chance of a 75 basis point hike in December. Finally, for the 19th straight month, Americans' cost of living increased as real wages tumbled. Oh, look, it's coming back. It's coming all the way back to almost where our initial entry in this sim trade on the full treasury was. I think I can leave that open though. I think there's a pretty good chance that this pops back up to 112 again. But I am thinking, well, we'll leave one open up there just in case if something really cool happens. But imagine if he just brings the whole thing down with him. Sam, yeah. Oh my gosh, that would be so crazy. Because he's right. Given the way that was working, he would have to have some dirt on Tether. And well, here's how I would see this playing out. Just I'm speculating here. Sorry if you're not interested in cryptocurrencies, but it's a big thing that's happening right now. We need to consider it for a moment. If they go after Sam, so if Sam Bankman-Fried is prosecuted for securities fraud or something like that, he could potentially rat out other people in exchange for a lighter sentence. That's how I see that potentially playing out, right? So that's the case where he would give dirt on Tether or something like that, right? It's probably just like a dream for me, but it's possible. But my own metrics still show that Bitcoin could go as low as 8,000. So, and if you want to see those charts, I post them on a regular basis on patreon.com/speculatorsap. I still have it. I never talk about it, but it's still there. You want to see the charts? He won't. He will be suicided. Maybe you're right, Lucas. Maybe you're right. Actually, you know what, Lucas? Don't give them ideas. We have a lot of people watching this stream today. You got to be careful what you regulars, you got to be careful what you say here. Don't give them too much information. And don't give them ideas. Yeah, FTX had every creator promoting it at some point, and now they're all recanting. So I wonder, because there was this whole thing, like wasn't he on the cover of Newsweek, or he was on the cover of one of those magazines and all that sort of stuff? Was all of that attention that he was getting really organic, or was it manipulated? I kind of have to wonder now. I actually never heard of FTX till the ticket. Well, so it was a couple of streams ago, like. Sorry, Newsquawk was just doing some analysis there. I think it was like midsummer when I first heard of him from one of you guys here on the stream, and somebody asked me about him. And I wish I could go back and find that, because my thinking at the time was like, well, anybody that's done that well is probably suspicious. Unusual gains should always be treated with suspicion, guys. Always. There's no free lunch, okay? There's no free lunch, and when somebody comes out with like some insane gain like that, they were probably doing something hyper risky. And you shouldn't expect them to be able to pull that off every year. Okay, so we are getting a little bit of a good uptrend here. It does look like so did I tell you this is really important for you guys, right? Cumulative delta is a very effective way of determining where to take profits. What do I mean? Well, look here on the treasury. A big move, the biggest moves that I've ever seen are on the order of 60,000 contracts, okay? So we have an up move. Before the move, this cumulative delta was reading negative 50K. Well, look at this. We got to zero, and then it started backing off and people started taking profits. Okay. Why is that? let's cover this because I know there's a lot of new people, and I want to share the important, valuable information that we have that I think would be valuable to every trader and to society as a whole. And that is that it is the orders that move markets. As a result of orders moving markets, markets are not very informationally efficient. So it could be the case, I don't really know, I'm just going to hypothecate here for a second. Perhaps given everything that we know now, the correct interest rate for the 10-year treasury is 3.75. That could be possible, okay? It's probably not, but you know, let's just say that that's what the fundamentals say. I don't have a way of calculating that, okay? We're not going to get to 3.75 today. There's just not enough volume. There's not enough orders to get us there. There's not enough orders to get us there, right? So you can basically get like 60,000 contracts all one direction, and then there's like not enough people left to trade. So it's going to have to pull back somewhat first. Doesn't mean that we won't go higher today, although it's pretty likely. It's pretty likely that we did hit the high today here in the Treasury, at least. Treasury usually tends to hit it early off of an event like that. Like it's very rare that you get a big jump like that, extension, and then trend day all day. Possible, but so orders are what moves markets. Markets are not informationally efficient. The current price does not reflect all currently available information. Rather, it reflects the orders. And so we can use that to our advantage. When we see a really big move, we can keep track of, you know, cumulative delta, the net market buys minus market sells. And once we get to about 50, 60K, that's about as far as they can go usually. And how far they get during that time depends on the liquidity. Yeah. Fed's Harker expects Fed can slow rate hikes pace in coming months, and at some point next year, Fed to hold at a restrictive stance. Well, so, you know, this number will change around a lot, and I found that the Fed tool is not really very up to date in action like this. But I'm going to bet that the chances of a 50 basis point hike in December have increased substantially. And there's probably some people even predicting a 25 basis. Like, here's the thing. If we get if December came in, core CPI in December came in at 0.3, then I think it's very possible that the Fed would only raise rates 25 basis points. Oh man, did you have trouble, NASDAQ killer, with Ninja Trader during that move? You know what, guys? So a market move like that is really too volatile to trade. It really is. Even if you have that, even if your data is working and everything, it moves so quick. Those kinds of moves are dangerous. Like, you could have come in here and been 100% right. Okay, and going long the treasuries here and still have been given a really bad price and have it come back on you and hit your stop, right? So yeah. So what happened to me, NASDAQ killer, was I came in and I saw an order at I think it was at 4.6. I saw 4.6. I clicked on it, and then about 2 minutes later, something like that, the order actually went through. And even though I had placed a limit order there, it placed my limit order at 3.96. It placed my order at 3.96. I almost wonder if my broker did something or you know, caught that in there, because it should not have filled that as on a limit order unless I saw that wrong. I guess we could go back on the replay and watch it again, but it got me in at 3.96, and then I was like, oh well, I don't know if I actually want to be in that now, so I got out of it as soon as I could. But it looks like I could have held it for at least $50. Do you think that 25 basis points would be irresponsible and stupid? I don't know. I'm putting up like a really crazy scenario, right, Lucas? Like I'm saying, if December CPI came in at 0.3, then 25 basis points might happen, right? But I think that would be a very different world from the world that we live in today. Okay, so it's probably a little bit too early to be making a call at like 25. But I'm just suggesting that you might start to see some people. Well, let's go look at what it's doing right now. The Fed tool. So there's tool that uses the SOFR futures, which are the short-term financing rates. It is going to replace the euro dollar, and they use that to determine like what the market is predicting for the next Federal Reserve meetings. So if we come over here to Fed Watch and we look at December's meeting, okay, and we do compare. Yeah, you can see how. So they were kind of leaning towards 50 basis points before, but now they're saying 85% chance. Oh, although there was actually some people saying 25 basis points, 14%, and there's none of that today. So it actually seems like they've centered in on that 50 basis points. Better to have sustained results before going that low. It might be. And you know, another issue that we probably have here, by the way, this is like, I'm going to take profit on this here because what I'm seeing is a pretty clear liquidity hole going up to 112. And so we're probably going to rotate in this area for a little while. I might be able to find some scalps in there, but for the moment, I think that it's good to take that profit. Let me shift that over. Okay. Anyways, what was I saying? Oh yeah. So again, because we had a good number, there was actually a post on this on Zero Hedge, and I agree with it. Which is that if you get the good CPI number, which is what happened, there's kind of a risk after the fact that happens, right? Because this market took off today, right? And I think that it's probably likely to continue through the week, unless the Federal Reserve comes out and says something super hawkish and like really puts a kibosh on the party. It's very, very likely that markets continue to rally, and we could get a good rally, right? But a good rally kind of eases the financial conditions, essentially. And so there's the risk that you ease the financial conditions too much, and the Federal Reserve kind of has to clamp down on things again. And this is like the longer term problem that I see. Because when I think about myself, you know, inflation, it hurts. We're getting through it, but my wife doesn't work this year, so we just have less income overall this year than usual. And I'm sitting here like I should get like a 20% raise, right? But if I get a 20% raise and everybody else gets a 20% raise, that doesn't really help the situation, does it? Right? So, but they're gonna have to do something. Like the company that I work for, they're going to have to give a larger cost of living increase to everybody. They're just going to have to, or they're going to lose employees, right? Which means that the Federal Reserve is still has a tough road ahead. Even if we've dealt with like the supply chain problems and everything else, you're still going to have this residual effect, which is why I think the Federal Reserve keeps saying higher for longer, right? They want to get the interest rate to a place where it's just slightly restrictive. You know, like maybe if it's too restrictive, they can back off a little bit, but they want it to be slightly restrictive, and they want it to be like that for a long time so that everything can catch up. Like wages can catch up to the cost of living without it being translated into higher spending again still, basically, right? I think that that's kind of the scenario. So you have to beware of a potential decline in the S&P 500 at some point from them getting too hot, right? But for today, that move was like a close your eyes and click buy, right? Close your eyes and click buy. I'm wondering how far the treasuries can pull back here. We might get like some sort of a VWAP bounce as possible. Let's just kind of keep an eye on it here. I don't know. So NASDAQ killer, when we were talking about my data feed, you know, I was saying, well, it could be a couple of different things. So I was pulling up my system resources and my system was fine. I was only at like 60% resource utilization. So it can't be my machine. I do think that the software was like tracking things correctly, although I do get this thing. So even when you put a sim order in, it is sending data to like Jigsaw's server. That's why like sometime in that action you'll click an order and like nothing happens, right? But you know, my data feed was clearly lagged. It's not guaranteed that it was Rhythmic's fault though, right? It could be that I was just pulling down too much data. So for instance, you know, I have all of these instruments up, right? It could be that they're throttling the data and saying we're only going to send each person this many updates per second, right? Something like that. So there's a lot of different things that could have affected you. It's not necessarily your broker or your data feed's fault, but it could be. Oliver says that he had issues with Rhythmic and he only had one ES DOM up. Really? But there were other people that said that they didn't have any problems with Rhythmic. So I don't know. Like maybe it has to do with the size of your internet connection. Like maybe if I had the 10G connection instead of the 1G, I don't know. All I know is I've never seen a situation when you get to the really big news releases, it's usually not tradable for us. And that was what happened here. Hope you have a good portfolio of stocks that benefited from it. Did you buy CPI? Well, I did take a trade. I tried to pick off an order. Like I said, I at 4.6 I saw an order that I tried to pick off. I sold into it with a limit order and it did not get put out. And then when I finally saw it put me into a position at 3.97, it put me into a position, and then I was up 30 ticks on it at one point. So it got to where it is right now, 3.94, but my feed was still lagged, and so I just got out at wherever we were, which was only like $15. So I did make $15 off of it, but it was not a real trade, right? It was not the way that I wanted to do it. It was like, because it did not give me the price that I wanted, right? Yeah, the Axia guys maybe made a killing off of that. So actually, no, I don't think that they do use TT actually, because I think that they are using TT as their broker and everything, but that they're using Jigsaw DOMs actually. This is what I think Axia uses, or last time I checked. So I don't know. Like I'm sure that if I had like IQ feed, which is like crazy expensive. But you know, if I had a IQ feed, maybe it would have been better, right? Well, it probably changes by trader too. Probably some traders prefer the TT DOM and some, I don't know. Nah, I've definitely seen Axia traders using Jigsaw before. Although, when I saw it, the one that I'm thinking of in particular, that I remember watching, they have that they're using the skin that kind of makes it look like TT. Or not the one that makes it look like TT, the one that makes it look like the old X trader. Yeah. Wonder if TT data in London gets there, business? I don't know. I mean, the thing is that if they did trade off of, I mean, just go watch. I'm gonna bet you that before the end of the week they'll have a video up of somebody trading it, and we'll see. But I'm gonna bet, like, if you came in and you traded treasuries off of it, you know, it would be pretty hard to get anything below 14, right? It'd be really hard to get anything below 111, 14. Like this whole area through here. Okay, like we basically, the open was basically where the trade started from. Okay, like look at this huge gap here in the treasury where literally nothing traded through here. Right? So, and that all of this happened instantly. So probably any of the guys sitting there at Axia, probably the first price that they possibly would have gotten would have been 14, right? You could place an order before CPI, but that's crazy risky, right? Like just imagine. Okay, the NASDAQ is now up 4.5%, right? But they could have gone the wrong way. Like what if they came in and they thought the CPI was going to be bad and they were short the treasuries, right? That would have been bad, right? So I'm with the way that they tend to trade, they probably wouldn't have a position on before the news. So let me see this one. Yeah, that one is definitely not Jigsaw. I think I can't really tell. This is too small. I think that is trading technology. So I think that's the symbol that you get up there for TT. But like I was saying, I think that they are using trading technology like as their basis and their data and everything. But I do think that there are some of them that are using Jigsaw. I'm pretty confident that there are some of them that are using Jigsaw. But clearly from that means that not all of them. Just because there were a lot of feature, like the way that the LTQ column works and everything. If I recall correctly, they added that in there for Axia. So. But back to the point, I don't see anything in the way that my platform performed during the event that suggests to me that it has anything to do with the platforms. So this was totally a data provider thing. Now it's interesting. We've had about 3 people say that they had trouble with Rhythmic, and 1 person say that they didn't have any problems. And one of them were saying that they had trouble with Rhythmic and they only had 1 DOM up. I do kind of wonder though, if what would have happened if I only had ZN up. He wasn't using the volume. Are you mean the volume profile? Are you guys talking about the volume profile? No, people who traded well on Jigsaw jumped into DOMs with no volume information and did terrible. Well, in a move like here's the thing. Like again, I'm sorry, but if you're trading that move and you think that you're trading it off of some technical indicator, you're lying to yourself, man. Okay? That everybody saw that the CPI number was really good and they were taking their trades off of that, right? And then everything else is just, it pulling back violently because of liquidity holes and so on and so forth, right? So in a situation like that, the DOM is valuable because it's the best way to execute, right? You can manage your orders and you can see what's going on really, really well. And you can watch a bunch of different markets very quickly, right? That's the advantage of the DOM. Seeing the order flow information in there, it's going through too fast for you to really glean anything from it, right? Okay. Joseph Wing doing a little tweet storm here was, let's see here. So first of all, Nick Timmeros, Fed officials have signaled that they would prefer to see evidence that inflation is moderating before they pause rate rises. The hot August and September CPI prints restarted the clock on gathering a string of sequential moderators in inflation. Okay. Joseph Wang, as the government has been hinting, they want to move the treasury market to all trading like the stock market. This will help market liquidity, but doesn't get to the key problem in my opinion. So today, if you sell or buy a treasury, you trade with a dealer. The dealer buys securities from investors, holds them in inventory, then resells them to other clients. However, sometimes dealers reach their limit and cannot buy another more security. When this happens, then investors have trouble selling treasuries and market liquidity goes down. All in all is an attempt to fix this by allowing investors to pass dealers and sell directly to other investors. In theory, this is removing a potential bottleneck, but you don't have to depend on the capacity of dealers anymore, thus liquidity can be improved. Now, I don't think that would, so I don't know what he's going to say here, but I don't think that would solve the problem because you still have to have somebody in the market providing the liquidity, and who wants to provide liquidity in, the last year in treasuries, for instance, right? Anyways, but I think the much more fundamental problem is not intermediation capacity, but finding end investors who are willing to hold the enormous amount of treasuries that are going to be issued. All-to-all trading does not help that and likely would not have helped in March of 2020. Yep. That is, he was basically saying the same thing that I said there, isn't it? Okay, what's this? Sam Bankman-Fried tweets that he is in talks with a number of investors. Priority is users. Why would anybody give him money knowing that he basically just committed fraud? I mean, if I was going to give them money, one of my stipulations is that Sam and everybody else involved leaves. Oh well. Live action, I think you have a very good point. I don't remember what my point was anymore, so I hope it was a good one. I think my point was that, I didn't see any problems with the platforms. It looks like it was on the data, and when you have such a crazy move, it's really likely that you have a problem with data unless you're paying a lot for your data. Slayer Trades, new to the channel. Thank you very much for joining. I've seen other traders use options order flow to predict direction, but I was looking for insight on order flow in futures. Yeah, well, so tracking open positions in options and the strike prices that they've done at, and making calculations about whether the market is long or short gamma at specific locations can be a very effective tool to use. And if you're trading e-minis in particular, I would really strongly recommend you pay attention to that sort of stuff. And I do have a video about that, about options gamma, that was a month or two ago that I put out. But in terms of the flow, the whole thing here is that the orders are what moves the markets. So first of all, I have to see the orders to even understand what's going on, right? Like, you got to be careful, like seeing one piece of market generated data. So seeing that, like, 104 contracts, 600 contracts now just sold and took us down 2 ticks is not very useful in predicting what's going to happen next. And there are only a few narrow situations where you can look at a move and volume and liquidity and everything, and just from that technical information, what's going to happen, right? So there's another component of it, right? Because the big unknown is always, what are the future orders, right? Like if somebody came in and bought 50,000 contracts in the treasuries here, we would move up and we would probably breach the highs. 50,000 contracts would probably do it here. Although they would maybe wait a little bit longer before they would do that trade. Okay. But it's the orders that move the markets. So we have to predict those future orders, like especially those future market orders. That's kind of the problem, is that, like, whatever it is that you're seeing right here, the people that are coming in and clicking buy and sell, market buy and sell, yeah, there are some people that are looking at some chart pattern or something like that and trying to make their decisions off of that, or they were already in a trade. Like, yeah, there is some of that, but the studies show that, like, the bulk of that activity you can't predict like that. In fact, the largest players in the markets are just like rebalancing their portfolios, and you can't predict what they're going to do with their portfolio rebalancing unless like how much money they got in and all. So you can't just look at a chart and predict what they're going to do, right? And those flows are bigger than almost anything else. Okay, so that's why we have to predict those sorts of things. We have to predict the future orders, right? So it's still order flow reading, right? It's still reading order flow. It's just the key component that I think people forget is you've got to sit down and say, okay, but what is actually going to drive those order flows, right? Is there a change in expectations of future fundamentals and future flows that are causing people to trade? Is there, there's all these things that you can use to predict future flows, news being a really, really important one, right? Once you have something like that, then you can use the things that we know about order flow and what you're watching in the current market data to make some determinations about how you want to trade. So maybe we have a good situation right here. Okay, so we just had a pretty strong move up there, and then somebody bid at 112. Well, it already happened. I was about to say, if that doesn't pull, they're going to trade it. Okay, but here's the thing: we already had the big move up on CPI, and there is a tendency in order flow where if large trades happen at a location, that it kind of creates this liquidity hole that they just end up rotating around, and it's very difficult for them to get out of it. And so I didn't see any news or anything like that. So I don't see any reason why somebody would be bidding the market up and putting a big order like that there. Ergo, my take here in this situation is they were likely to rotate around this. If I still had my position on, I probably would have taken profits on it, right? Ding, 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 ding. Are you saying that because the S&P 500 just started? It didn't give me my sound again. I don't know why. It tried to play it. I just didn't hear it. Yeah, it seems you have immense patience and place very few trades. I'm having trouble with this aspect of patience. So you're looking for mini momentum bursts for longer term trends. Is it like level 2? So not quite. So the first thing that I want to see, Slayer, is I have to have a reason to trade, right? I have to have a reason to believe that I'm going to be able to predict what the future orders are. That's the thing that keeps me very selective about my trades, right? So in this particular situation, we've moved so far, right? If there's no way that I'm going to short this, it'd be crazy. Or in this case, if I'm going to trade it into the micros, there's no way that I'm going to go, try and buy yields here, right? Like the momentum is down. Is there a risk that it's going to go lower? For sure. I mean, especially with the prices that they're at and everything, it's just a little skip down, right? But what do I know right now that's going to tell me that there's going to be another wave of buying here in the treasury to push those yields down? I don't have that, so I don't take a trade. And I tend to limit my trades to situations where I have that. Now, sometimes I do. Sometimes I can come in and I can say, well, it's the last day of the month, so they're going to be rebalancing and they're likely to be buying because of this. Or there's all these pressures, and I can kind of look at all the different pressures for that day, and sometimes I know that they're likely to be more to the long side, right? So then what am I looking for after that? If I know that I have something that's going to predict the order flows, right? Well, I'm going to be looking for some flows that are kind of supportive of that, and I'm going to be looking for an optimal location. So if I am able to see a move against the direction that I want it to go, that slows down and there wasn't very much volume behind it, that's perfect. Then I want to get in on that, right? Because they're giving me a good price. And then once I get in, I want to see more market buy orders after me. And I want to see like my cumulative delta rising in a steady autocorrelated trend, right? Because that's like the confirmation for me when I'm getting in. And then when do I get out? I get out when I see the amount of change in cumulative delta that I wanted to see, or I see a liquidity hole like what we were talking about earlier. I see a liquidity hole that's like, it's probably going to be stuck there for a little while. So like, why sit in it for 45 minutes? Just take your profits and like relax. And then if you really want to take it again, you can get back in 45 minutes later, right? So that's the gist of how I'm trading, right? See, I would short, and why I get destroyed thinking exhaustion. I see this is totally wrong. Your viewpoint is like 180 every trade out there, but it's making a ton of sense. So fast do you cut? Yeah. So if I got, it moved down a little bit, I got in, and it's already like 10 ticks against me over here in the micro yields, then I'm gonna be like, yeah, I'm out. It's not doing what I think it should. And when I take a trade, it should start coming my way within 15 minutes. So I'm not going to sit in one for very long. Well, we are seeing a new low here in the yields because the 30-year is pushing up very aggressively here. It looks to me like when the news happened that we had a really strong steepener come in, and now maybe the 30-year is rising here because people are looking for flatteners as a mean reversion trade. So that one is, you might be tempted to interpret this order flow that we're seeing right here as an opportunity to go long, but I think that it's mostly being driven by the spreads, so you kind of have to discount that on that one. Okay, how can this apply to swing trading? Oh, well, I think it's the same. That's the same sort of a thing. It's just that when you take a trade based off of a swing trade, you have to be saying, what do I know that is going to predict the orders over a multiple day time frame instead, right? And sometimes there are situations like that. This today is probably one such situation. I think that there is a very, very high probability that we close the week above 3,900, right? So how much heat you're going to take on that first, I don't know, but probably a pretty good chance that we close the week above 3,900, yeah? Because we're barely touching it today. Maybe that's the high for today. Then they go and test it tomorrow, maybe. Well, I guess it's Thursday, so we only get today and tomorrow, huh? I didn't think about that. But if not this week, next week, right? Looking to build an immense short position at 4,000. Okay, well, so you'd mentioned something earlier about like the opposite way that people think is like, oh, it's up here. I would be looking for a short on exhaustion and it's gone too far and everything. Sure, because you're thinking like everybody's gotten in and they're going to take their profits or whatever. But the thing that we have to be thinking is, what are the future orders going to be? Well, right now it looks like the future orders are long. I can't say if it's really going to continue or not, right? But one thing that I do know is that because we've moved through this location fairly quickly, it does leave the liquidity below us a little bit vulnerable, right? So especially on a scalp, you can take these situations where you might be able to get a few ticks on it pulling back because of the liquidity hole, right? But that's a difficult trade to make money on if you're not like an HFT, right? Which is why I only take those ones on sim. And though I've been doing really well with them lately. I don't know. But it's better. You need to have a predictor of order flow, right? Otherwise, what are you doing? You're trading noise. You're a noise trader, Ned, which is what most retail traders do. Is they think that there's some pattern, but the reality is that it's just noise. And the way that they're making money is they have this huge stop so that they win most of the time. And then, maybe once a year they blow their account or something like that, right? I don't know. There's still some fairly aggressive buying order flow up in here. It kind of makes me think back to the place where I did have a position. If I should have just like calmed down and let it go, but I get too nervous when my data is kind of being wonky like that. So I think it's okay, but it's just in retrospect. I was worried. Like the issue was when I caught that was like not the price that I clicked on. So I was worried that I could be buying the high for all I know. Like the move and the flow that I've seen so far is enough, right? So I panicked, but in retrospect, it was actually a pretty lucky spot. I have no stop, all wins. There you go. Like the dirty truth is that a lot of these high frequency trading algorithms are taking on a lot of risk per trade and basically will take big losses, right? And here's the thing, they can afford to do that, right? They come in and they can make money every day, and then one day they lose a ton, but then they're still going to come out profitable for the year, right? But for a retail trader, that day when it like goes against you and you take the big loss, that's usually like the size of your entire account, right? and then you blow the account. Retail trader can't afford to take on the amount of risk that is necessary to be able to play that game. But you'll always see a lot of people showing you profits and bragging about playing that game and making money in the short term. Yeah, it's like a combination of fundamentals and news. Yeah, well, I don't use the word fundamentals and news. I probably should, because, you know, that would like resonate with some people that want to trade news, I guess. But I say that because it's not the fundamentals that move it. Changes in expectations of future fundamentals and future order flows is one of the strongest predictors of order flow that you're ever going to get. But it's not the only predictor of order flow, right? So there was this, I have a video about this, about the inelastic markets hypothesis, where we kind of talk into this. And at the end of that video, it goes down through a list of possible predictors of order flow, right? So for instance, gamma positioning, that has nothing to do with the fundamentals, right? That's, you know, if we're going to define technicals as things that have nothing to do with the fundamentals, right? There are technical things that can predict order flows too, right? It's just that from all of the investigation that I've done, a past price movement or pattern is not a predictor of order flow at all. Watch that video, mind blown. Oh, good. I'm glad that you actually, have you commented on a video or something? Because your name seems awfully familiar to me. Is there a way to watch that information on the NinjaTrader 8 Super Dom? Kind of. So on the NinjaTrader 8 Dom, you can come in and there's a volume profile column, and they show you the bid and offer. So you can come in and if you're really good, you can say, okay, they had 300 contracts on here, and when they ticked up, I only saw that this number increased 50. But it is a heck of a lot more difficult than it is doing it with Jigsaw. But yes, technically you can do it in NinjaTrader, but the NinjaTrader DOMs is terrible. It's interesting. We're coming back down here now in the 30-year, and the 30-year is coming back a little bit harder than the others. The 10-year is holding there pretty well. I am a little bit nervous about trying to short this below 3.9, really. I suppose that a counter trade might make sense here, but that's way too risky. That's way too risky in this situation. This is a buy day. Like the trade today was, you hear that number, you close your eyes and you click buy and hope that you got a good spot. And I did that, and my data feed was not cooperating with me, so I just took the little bit that I could. But that's the way that you got to play that. Man, the bots are persistent today, huh? I'm really glad that I'm seeing more and more people resonate with those videos, though, because it really bothers me that there's this really solid empirical data about the nature of markets and what the majority that contradicts what the majority of people believe, and there's hardly anybody out there talking about it. And when I talk about it, it seems like people don't care or they're not interested, when it's like, as a trader, that's probably the most valuable piece of information out there, right? So when people come by and they watch those videos and it resonated with them, that really feels good. That makes me go, okay, I am heading in the right direction. I'm not completely screwing this up. I am having an impact in helping people. And yeah, so I don't do this full time, no. And in fact, when I'm trading here, yeah, I'm trading tiny, right? I made $15 today. I made $15 today, which really cancels out the $5 loss that I had yesterday, and then plus 10. Cool. I'm happy with that. If I come in and I make $10 every day, $20 would be better, but $20 every day, I'm happy. Because I'm more interested in trading and getting as good at trading as possible, more so than I am anything else. And while inflation has been tough, and I do wish that I had a little bit more cash, I'm not, I do pretty good. with the day job. So for day job, I am a software developer. I wish I had that discipline. Well, you know what, Slayer? I do not have that discipline by choice. So when I started trading, there was so many days, and you can go, because basically all of my trading, I mean, I traded for like a year before I started streaming, at least traded futures for a year. So to finish the first question before I go into this, I worked for one of the big banks from 2010 to 2016. And I was really into the markets ever since 2008, just trying to learn as much as I could. I read a lot of books up into that point, learned a lot at the banks. And then after I did get laid off from the bank, they do lots of layoffs. So it happens. But then I had the opportunity to do futures trading. And so I did futures trading for a year. And then I started streaming, and I didn't start streaming like, oh, I'm this big guru and everybody should listen to me. So it was just a trade journal, but people were watching, and I very quickly realized that I knew a lot of things that they didn't. So I just share what I know, and I think of it more as a collaboration. Like, I don't like to think of myself as a guru. I'm sharing with you guys the information that I know. The information I know is that the market is more informationally efficient than it is statistically efficient. So there's more opportunity in the informational inefficiency, and that's why we're looking for predictors of order flow and all that sort of stuff, right? Anyways, but I still do a day job, and I'm a software developer. It's for a healthcare exchange. So software developer is a good gig, man. Every time I come in, I see a kid that's like, 16, 17. They're like, oh yeah, I want to become a trader to make money. I'm like, well, you should probably become a software developer. That would be easier. And if you do become a trader, go to school, learn market microstructure in school, and do execution for one of the big banks, and do real trading and not this, tiny retail trading. I missed the part where you shared your edge. Well, so I kind of did share it, but you might have come in halfway through the conversation, or you might not have understood what I was saying. So I have a video series called my order flow series. There's like a playlist right here. Pull it up. They're still chilling out here at the high, like. It's much easier to have a steady paycheck. I own my business, but it's just as risky as trading. Oh, really? Yeah, so like that's one of the big things is I think a lot of people say, oh yeah, futures trading is my ticket to success and money. And the reality is that futures trading is really more of a sweetener for already rich people, right? Okay, so if you come here to my channel, I do have this order flow video series, right? So you start with the order flow and DOM trading. So if you don't understand that stuff, I think that that's all really valuable information, like how to read the DOM, what you're seeing, the sorts of things that you tend to see, right? And then I have this one, these last two, the stylized behavior of markets. This describes behaviors that you will see on the order book that you can use to your advantage, right? So when I'm talking in through here, it's not like these are things like, if you just look for this pattern and follow this pattern, that's what's going to make your money. No, you need to have predictors of order flow, but using those patterns as a part of your entry process is advantageous to you. Okay, you'll get better spots if you understand these stylized behaviors of markets, all right? And then this last one, the inelastic markets, basically explains why markets behave the way that they do, why it is so difficult to make money trading. All of these confusing, difficult questions that retail traders ask themselves about trading in general get answered in that video. And that is the edge. And I'm telling you combine all of that stuff together, that is the edge. The edge is not looking for a pattern, sitting here, being real selective and waiting for some pattern. No, it's not that. It's knowing what's going to happen and being able to execute that better than other people. Why didn't you simply join the algo developers department? Well, so first of all, the people that are doing the algo development at Goldman Sachs have some skills and knowledge that is far beyond my own. I'm working on getting there, but I think it'll be a few years before I kind of have that level of expertise in the quant field. There's actually really sophisticated stuff in math, and a lot of these people were like math PhDs and stuff, right? But the other thing is that I wanted to make the move over to trading, but there were two things that kind of prevented that from happening. The first was that I live in Salt Lake City and I want to continue living in Salt Lake City. I didn't really want to move over to New York. I think there was a time where I said, well, maybe we can eventually move to New York. The thing is that, you know, I was married. I was in my first marriage when I worked for the bank. And, you know, so I thought that we were going to have a kid and everything like that. But the reality is it was just really hard for her to get pregnant and it never happened. And so I probably should have done it. I probably should have said, you know what? I want to move to New York. I want to live in New York. I should have done it. But I didn't. I had different priorities and some things didn't work out. So there was that thing. But then the other thing that happened was that I worked on their risk control systems. And there was a trader at JP Morgan in London that had done the same job that I was doing, basically, and then moved over to being a trader. And because of the knowledge that he had of the risk control systems, he was able to bypass the risk controls and take on excessive positions that were in excess of what their controllers were allowing. And this guy is known as the London Whale. And when the London Whale happened, it was like, you know, the other companies always respond to that sort of stuff. They're like, okay, well, like, we got to make sure that never happens here, right? And my manager, he said, like, you understand that there's probably no way that you can trade now because you work on this system, right? I was like, yeah, I know, I understand. So that was kind of when I kind of realized that wasn't happening, at least not anytime soon. And then it wasn't a year or two after that I left. So was he in that? I don't recall what it was he was trading in, but he had these massive positions that caused a little bit of trouble in the markets. And I think that they took a lot. I think that JP Morgan took a big loss off of him, if I recall correctly. Yeah, they basically looked through like all of the security on their system and everything to make sure that like there's no way that anybody could do that sort of thing and stuff. I look back on that, for him to be able to do that at JP Morgan, it would almost have to be like he was either making backdoors or their system was just not designed very well. Because at our system, if I had administrator access to the system, to like the actual machine that it's running on, there's some things that I could do, but there were some parts of that system that just nothing could touch. So I wouldn't be able to do all of that much, right? Unless I went in and like straight up increased my credit limit. It was CDS again. I think that it was some fixed income kind of instrument that I don't ever mess with or play with. So I was watching, there's this guy on LinkedIn that I'm following named Nicholas Burgess, and or is it Burgess or Burgesses? Anyways, and he's coming out with a book soon about high frequency trading in fixed income markets. He gave a presentation at a college yesterday that I watched, and he was talking about swaps and stuff like that. It was very interesting, but it was super hard to follow along with because his internet connection wasn't very good, and like the audio was constantly cutting out, and I could not focus on that at all. So I don't think I learned as much about it as I would like, but I'm excited to see his book. And I think that gave me a good idea of like how his book would be different from like Stigum. Their risk system literally had an exception built in for hedged position with greater than 50 delta offset. The system didn't even kick in to prevent the buildup or throw up a red flash. Oh. Well, you know, to that point, the risk systems that I worked on were for equities, and I don't think that they even tracked the fixed income instruments. I was in equities technology, so. Like, I tell you what, some things you don't realize how valuable they are until you no longer have access to them. So being able to see the position and credit limit of every customer, that's some valuable information. I knew it at the time. I knew that it was valuable information, but it was like, well, yeah, but what can I actually do with it, right? Now I know. Now I know, like, oh, dude, go in, take, export the data to a spreadsheet every day, and then use that information, combine that with larger order flow from the market, and use that to be able to identify when institutional flows are coming into a thing so that you can create some possible signals. Like I think I would know what to do with it now, but. Does your method apply to all futures instruments and even individual stocks? Okay, so what we know about the stylized behavior of markets, these are tendencies that tend to happen. And also the inelastic markets hypothesis are all properties that are caused by the use of a limit order book. So any market that is trading with a limit order book will display these kinds of behaviors. Yes. And particularly, I mean, like the bigger thing here is that like in the end, what really drives markets or like, where is the greatest amount of edge to be found? It's in informational asymmetry, right? On a move like this in CPI, since everybody knows that the CPI is good, where's the informational asymmetry? The informational asymmetry is in knowing, like, based off of that change, what is a reasonable interest rate now? That would be one thing that you could calculate that I think I probably could calculate, but, not on the fly. Or you have better market data, that's faster and gives you a better idea of where we're going and stuff, It's all informational asymmetry, man. Oh yeah, I still see some of your older videos on day trading, trade psychology. Yes, they totally are. So, all of those videos that I made earlier are really about my frustrations with what I see the average retail trader do, right? So one of the frustrations that I have with the average retail trader is that you get a lot of people that want to come in and trade, and it's really just not suitable for them. They want it to be their sole source of income, and they don't already have a good source of income. So that right away is going to kill you. If futures trading is like your whole living, that sucks, man. It really sucks. You don't want it to be your whole living. That, like, if you have a bad month that you go hungry, you don't want that. Okay. But then also, like, what are the sorts of things that you're going to want to be interested in to be good at futures trading? Well, you can go and watch that video, but the gist of it is you need to enjoy reading news and doing math, right? If you hate math and you hate reading the news, then futures trading is not for you. Like my wife, I think my wife has some traits that would probably make her a really good market maker. But guess what? She doesn't give a crap about the news, and she doesn't give a crap about math. And so really wouldn't make sense for her to try trading futures, right? So a lot of those sorts of things. So yes, every video, I've never made content that I couldn't back up with like real data. or logic, right? I'm not the kind that comes in and says, oh, okay, if you take a Renko chart and you do this, this, and this, and then this seems to work out. And not because I backtest. I'm way more picky about how I do my backtests, and my backtest always comes back and says it's not worth trading, right? And I don't have these things like, there's some of these videos that are like, I've decoded the way that they manipulate you, and here's this trade that you can take. It's nonsense, man. They don't, they have a theory about the way the market works that they're trading off of, and they think it works because they've had a little bit of success from it, but they don't really have enough information to really know, right? They don't have enough information to prove it. Have you taken John Grady's webinar? No, I've not. So there was one time, I tell you what, people send me all sorts of stuff because we've been doing this for 5 years. And like the big advantage that I have, and one of the big reasons to watch the channel, like the live stream, is that I'm able to aggregate information from a lot of different sources that it's difficult to get to otherwise, right? So people have sent me recordings of his webinar, and I watched like one day of it to get an idea of what it was like. But I've never taken the webinar. And my why would somebody, that's spammers have been calling me at weird hours these days. Anyways, I think John Grady's beginner course that's really where I started, and I think there's a lot of cool stuff in that book. I think that just think of it as a book to read, even if it's for entertainment, but it's totally worth getting. I think his beginner's course. Okay. The webinar, is it necessary to take I don't think so. I think that I have enough information on this channel that between John Grady's book and the information on this channel and just trading on your own, or I mean watching the markets rather, and hanging out here and keeping up on what are the current happenings in the market, I think that you can get there. And I wouldn't recommend going to things like the webinars or like the additional jigsaw education, like paying serious money for it, because these are like thousands of dollars at that point, right? I wouldn't start spending that kind of money unless you've really put a lot of effort into it and you're really struggling to understand order flow, right? So it's not that his product is no good. It's a really good product. It's just you have to consider if it's really valuable for you. I think for most people, like I think the majority of people that we see do this and have success with it, it's they already have a good job, and they, like myself, I have a pretty good job, and I can just spend a little bit of extra risk in the morning, right? Or their wife works, or they own a business, and that allows them to take on that additional risk. But that doesn't mean that they can spend like $4,000 on education, right? So really what I'm saying is, don't think that you need to spend thousands of dollars on this education to have a chance at being successful at futures trading, because that's not the case. Well, man, I said I'm really nervous about taking any kind of a trade below 3.9, but like this is not stopping. This is not stopping. Have you seen institutional traders build huge positions without? No. That was the first thing that I learned, I think. Well, I mean, I when I got to talk to the traders, that they focused on that. Like really, for those institutional traders, minimizing your impact is basically the whole game for them, is to try and minimize their impact on the markets, right? But yeah, what would happen is, the one thing that we would have to do is they would ask us to raise the credit limits on certain clients, because they were going to execute a trade for a client that would involve so like, say they wanted to own 10% of a company or something like that, they would utilize more margin than what the end position was going to be, because you can kind of buy it up a little bit and sell it a little bit and kind of push it around a little bit to get a better end execution, right? So we would have to, on those really big ones, we would have to raise their credit limits. So I would I would take notes. Okay, we raised this credit limit on this day. We raised this credit limit on this day. And then I would go back and look at the securities in question, and they were always up afterwards, every single time. Well, we're talking about situations where they were buying like 10% of a tiny company, right? So yeah, of course it moved it. So what do you think the smart money approach is? Are we at this point so commingled with algorithms that there is no rhyme and reason? So I think that the hedge funds out there that are really making, you know, like the Renaissance capital of the world, what they're doing is they're using proprietary order flows to gain insight into how certain institutional strategies work so that they can front run them is basically what they're doing. And some advanced math or surrounding correlations. Okay. But yeah, with algorithms, the pure market making approach is very, very difficult to pull off as a retail trader. And there's only a handful of people that can be successful with that. And you stand the best chance of being successful with that if you can find an exotic instrument that needs liquidity providers where you can benefit them, right? But yeah, and in a way that's what I'm doing. Yeah, it is. In a way that's what I'm doing is I'm kind of guesstimating. Okay, so we're getting a bit of volume here at 12. That might slow things down. Might cause a liquidity hole here at 12. Need to think about some timing here. So that was then this move starting about 7:30. So I think that the first little bit of a move that we had up was mostly to do with the S&P 500, and now this further extension would be a large meta order coming through afterwards. But we've probably felt the impact, most of the impact of that. So if we're going to take another trade, I think I would want to wait 30 minutes to 30 to 45 minutes before I'd be trying to do anything. Like garlic coin. They're constantly making fun of garlic coin because I've mined a really big wad of garlic coin. But yeah, I mean, if you want to be smart money, I think one way or another you got to understand what's going on in the market. Like you have to keep track of the news and stuff. Read Zero Hedge a lot and ignore all of their political articles, and just look for their articles where they summarize Wall Street research. That's what you want to do. That to be the smart money. And then just understand that even after all of that, it's still super, super hard, right? And like that's kind of the thing, is that an informational inefficiency, it's abundant, it's everywhere, and it's a lot easier for you to take advantage of, but it's not as consistent, right? Because you might have a real advantage and then something else comes in and just completely cancels it out. You know, it probably wouldn't happen on a day like today, but I can't tell you how many times we've had like a piece of economic news that was highly anticipated and it surprised the market, and then something came in unrelated and like completely destroys your trade. That happens. That's happened to me countless times, you know? And this is just the nature of an informational inefficiency, is like, yeah, well, you had something that predicted the order flow and then something else came in that you weren't expecting that is also predictive of order flow and canceled out your trade. Happens all the time. So the informational inefficiency tends to be not as reliable. Whereas if you can find a technical inefficiency, those are things that you know, especially if it's created by the market microstructure, you should be able to use that forever. But the problem with that is that it's competitive, and a retail trader is usually not competitive in it, right? If it was 1999, then we could play that game, right? So robots weren't around. I'm wondering, so part of this has been, I think, since the equities open, The dollar just keeps dropping. Man, dollar touching 108 today. That's a pretty big change. That's a pretty big change. That's like a 10% change, isn't it? On the day for well, let's see here. Two divided by 110. Oh, I'm sorry. It's a 2. It's almost a 2% change. Is the Nasdaq up 5.5% now? Yeah, 5.46. Isn't it crazy? But I said if you came to the very beginning of the stream, I called it. I said the VIX is pricing in 2.5% move, and the banks have some scenarios down where they could move 5%. And sure enough, 5.53 in NQ, and like it's not slowing down at all yet. Like we've only been open for 45 minutes. It's well beyond the point where I feel like I can take any trade. Like look at this. I said nah, I don't think I can really continue to take a trade here. It's gotten $50 since then. What the hell comes? These moves are crazy. How can we deal with this? Well, the way that I've dealt with it today is if I don't have something that's going to continue to predict the order flow, then I don't get in. I mean, could you in this situation say that the flow is just going to continue the whole way and I just need to hold it all? You could possibly justify and take that trade, and I do from time to time, but like that one never works out, so I've kind of like stopped doing it. But I guess I should have done it today, right? But like that's the whole thing, is that if you don't actually have that kind of information, then with the way that the market works, your expectancy is zero, basically. Your expectancy is zero unless you have an informational edge or you can do market making. So, oh yeah, I'm always looking for a situation where we can create a trend day, right? The issue is it's rare that a trend day is created off of an economic number. So it's usually there's like the big jump, and then they come back, and then maybe they take another leg or two, and then before the end of the day they pooter out, because a move like that creates such a huge liquidity vacuum behind it that it just really it really requires a tremendous amount of persistent order flow to keep that kind of a trend day going. You're more likely to get a trend day on a day where like market's not expecting anything unusual. It's just supposed to be a quiet day, and then somebody happened to decide to buy a ton that day and they just buy all day. That's much more likely to create a trend day. So when I got a gap, yeah, when I've got a gap, unless I feel like I know where the number should go to. So like, here's the thing, where's the terminal interest rate? So we were saying 50 basis points in December, and then 25 in January and February, and then that would put us to 5%, right? So I don't know if the terminal interest rate forecast has changed, but like the next even step in yields would be 3.75. Does this justify 3.75? I'm not so sure. So that's why I'm kind of stuck. I don't think that I can really predict these lows. And like, look at the pullbacks. Like that's a 20 tick pullback. I don't like losing $20 on a trade. I can only do that 2 or 3 times before it's like a really bad day. So that's why I'm not touching it. I think that while we were talking, I might have been able to justify taking a trade long in the treasuries after the S&P 500 opened, but I played it safe. And you know what? I've been trying to play it a little bit more safe this week because I did have last Wednesday I took a bad loser. So there was that. And I felt like I wasn't super in line with the market, so I kind of pulled back on risk. So I had a good week so far. So next week I might be able to be a little bit more aggressive, but I don't want to like overstep it. I think the issue is when you get a big move, like if you didn't get a good spot on the initial move and you can just hold, right? Because I could have just held and I would have made $100, but you know, I took it off. So once you've taken it off and you start trying to take positions in here, you just get chopped up, right? Like the volatility gets really extreme, and it's very hard to hold risk. So it's just not worth bothering with. I know that sucks if you're watching the stream and you want to see me take a trade, but so if we have another good CPI data in December, the Fed is going to have a party. Yeah. Well, to be honest with you, I'm still a little bit unsure why it ended up being 0.3. That's a little bit like, oh, okay. 0.3 is like what we want core CPI to be. Okay. It being 0.3 actually concerns me a little bit. You know, like it being 0.3 maybe suggests that some deflationary forces are coming into the economy faster than the Federal Reserve anticipates, and that they're going to have to flip around to interest rate cuts really quickly. Because the concern that I still have is that you kill inflation and then you have to ease and you bring it just flares right back up again, right? And so you're constantly in this cycle of like overextending on both sides. You don't want that, right? Like if inflation is under control, then we want the Federal Reserve to be able to back off and all of this stuff be gentle. And what we got here today was not gentle. It was insane volatility. Right? Like the stream itself was pushing almost 40 people at one point. We've traded well over 70,000 contracts long in the treasuries today. Like it's just nuts. You know, on any one move, it's about 60,000, but like over the course of a day, I think that we could get to 1 or 200K. So it's not out of the question to see a trend day in the treasury, but I'm not willing to put my neck out on that one. I'm too big of a pansy today, guys. You know what, though? I've been having issues. Like yesterday, I was feeling anxiety for no reason. Like when I say I'm feeling anxiety, I'm not like sitting there ruminating about something and having negative thoughts or anything like that. But like the physical feeling of that was all over me yesterday for some reason. After the stream, not during the stream, but after the stream, there was a lot of that. And I ran out of my gut medication. So I'm wondering if my body is kind of going into that, you know, kind of goes into like self-preservation mode, because if it thinks that you have a bowel infection, then that can slam you pretty hard. I'm probably going to start getting like really sleepy in today and tomorrow afternoon, because I don't know when I'll be able to get the medication again. It takes a while for it to get here sometimes. They have to send it by mail. So that's another reason why I'm a little bit tepid on risk. It's interesting because I've made some bad choices when I've been in that state before. So, well, they're still trading some pretty big trades here in the 13 area. It's interesting. It's kind of hard to sit and watch it just keep going, but you know, like I said, I think in this case he probably could have justified a trade somewhere, but I wasn't willing to take the risk for it. So we still got 40 minutes left though, so we'll see. I'm looking at like these highs. Sometimes when I get at highs, I'm always looking for like the level break trade and stuff, but I'm not seeing it this time. There's not really any super big orders above us. We're not near, well, we're right below 16. Order flow doesn't seem right. So that one doesn't seem to fit. We sure did come roaring back after a pretty decent, I like it went back to what? 28? 112.08. 08. Yeah, it was a big pullback. Actually, let's clear so we can see if when they're coming back over it. What a crazy day. You know what I should do now is I should come over to my Fidelity account and see how we did on that one. Because if I'm not up 5%, I'm gonna be a little unhappy about it. So my mix should I mean it's been able to handle the downtrends really well, but it should be able to it should get some good upside on a day like today too. I don't know if the whole thing will be up over 5%, but if those individual issues aren't, I'm going to be upset. Well, Fidelity's website's not loading for me. Oh, well, it's just being really slow. He's pushing. It looks like maybe he does want to do the level break. Let's see. I can see a few orders at 15 kind of pulling out of the way there a little bit. Okay. Oh yeah, we got to keep it tomorrow. Remember that tomorrow is a bank holiday. So even though like the stock market will be open and everything, like here in the bond market, it's going to be weird because the banks will be closed. Yeah, it's not that good. Well, so my silver position is up 7% today. Wow, and Sumo Logic is up 13%. Wow. But those positions are such a small portion of my overall portfolio now at this point that it doesn't come out to that much. And most of the gain that I got here came from my Berkshire shares and bank shares. It's not bad though. It's not bad. So, yeah, if they need to keep interest rates higher for quite some time, I have got a pay raise today of 6% came. Oh, wow. Well, yeah, that would certainly help. Yeah, I'm hoping they better give me 5% or I'm going to be mad. Trojans, I don't remember your name, but it's good to see people pop in and say hi. It's kind of funny, you know, over the past year, it's kind of, the stream has been a little bit quieter. And I've been like, I'm too boring, I'm too much this, I'm too much this. But it seems to me that like the popularity of the stream is very much related to what's happening in the market. So, day like today, we had a lot of viewers, yeah. Okay, so there's 16. You think they can get much beyond 16? 16 is kind of is considered a round number in the treasury. So you'll probably see a decent amount of volume trade at that price before they decide if they're going to go higher or what. I'm on baby duty. Man, so I'm just wondering here. So if I come over to a chart of the Japanese yen. Oh, is financial juice broken? Oh, you're right. I've been disconnected. Let me try. You know what? Like all of the market websites I'm trying here. So let me try Reddit. Yeah, Reddit loads up. Okay. What the hell? Dude. Guys, this is what freaking drives me effing crazy. Okay? So I come over here to Reddit now. And what's the top post that I see on my Reddit? r/day trading 2 hours ago. So basically when after the CPI hit, okay? WTF was it? Oh, sorry. Yeah, let me show you. Okay. Top post in r/day trading. WTF was it? And then it has a picture of what is this? The euro versus the dollar. Something happened. Such a significant surge. What was it? Right? This is why it pisses me off. There's only one thing that you should have been focused on today, and it was consumer price inflation. And the way that the day trading community is set up, it focuses you in 100% on charts, and it leaves new traders completely oblivious to huge events like that. Like, if you did not know that CPI was today and that it was likely to move the markets, you probably shouldn't be trading. You probably don't know enough to be trading yet. You know? It's just like, how can you be... But the reality is there's always a large group of people that are completely oblivious to it. Is it not obvious? It hit support and buyer's bought. That's why it went up. Lucas. Freaking... It's effing hilarious. Wait, let's see. I hope the comments aren't too bad. I mean, I'm being super mean to the user right there, right? But like, come on. You trade Forex and you're not keeping an eye on economic news? How are you not aware of this? I mean, it's only been talked about for a week or so ahead of time. OP says, I am just learning. I do not trade. Could you please elaborate how this affects the strength of the dollar? He got downvoted 25 for asking a question. Oh, man. Oh, I just can't. CPI dog. I lost 80% of my puts. Congrats, bulls. Yeah. John Locke 97. F you. Listen, I've been on both sides, so I probably shouldn't be hating somebody just because they were a bear, but you know what? I called it though. Didn't I say, haven't I been saying all week I have high hopes for CPI? Ooh, man, sure did. Wow. It sure came through, didn't it? It sure came through. I had high hopes and they more than exceeded my expectations. Treasury's pushing the bottom side of their range at the moment. What the hell, people? Is no one reading basic economic books anymore? The first response is show off. Yep. Guys, if you want to have a snowball's chance in hell of successfully trading, you need to watch economic calendars for influential events such as CPI data, which caused a spike this morning. I can't believe posts like this keep popping up on a day trading sub. Here's the thing, I've never read like an economic book like that. Everything that I know, I learned from watching CNBC and reading the news. you know, and like a subject would come up and I'd be like, oh, I need to know more about that. And I guess I learned a lot at the bank. You know, I've been going through like this Series 65 exam, and I'm realizing that the education that they gave me at the bank covered almost everything that was in there. So I knew a lot because of that. But still. Oh, the market makers went after my stop loss. That's why it moved. Oh man, that you get an upvote, my friend. That was hilarious. It'll reverse. Today will be very red. Okay, yeah. This is going to be one of the best. Yeah, it's probably going to be the biggest bull day of the year. Not of all time, because there was those days after COVID, but this is pretty wild. Pretty wow. I'm looking at my portfolio here because I bought some of these when I thought they were already kind of down. And it kind of makes me mad just because if I had waited and put the money in at a better position, you know, that would have been an extra 4% on the portfolio. Like that would be putting me over 7K now. Their explanation of what they do always assumes the market makers trade naked. Yeah, well, notification. Okay, so this person thinks there's certain patterns. Okay, prove it. Is that what we should say? Ironically, I've been so consistently unprofitably these past 2 years that I'm quite sure that once I finally turn the corner, it won't be a case of luck, dude. You're trading noise, dude. How do I approach this one? Can you some of your strategies just go with the flow? Nah. Because I don't just go with the flow, right? I mean, there are some situations where I see a trend coming in and I'll jump on board with it. But I don't want to just go with the flow. I want to know that the flow is coming first. Right? I want to predict it. Right? The strategy is know what's going to happen and then trade in accordance with that. Right? Doing this has really opened my eyes to why trading is so hard and all of the problems that people run into. Because the reality of how the market works, if you really look at the most high level things that that we know happens in markets and can potentially provide edge for you, they're really not that complicated. They're really actually quite simple. The market is competitive, right? Your orders have impact, and it's easier to make money from knowing something than it is looking for a pattern, right? Those are like the most high level things, I think. And so if I come in, they all say you can't predict anything, right? So like the thing is that if I come in and I try and explain that to somebody in like a one sentence thing, because the problem is I can say that, but it's like, okay, prove it, because it kind of contradicts what most people are taught to begin with, right? So how do you prove it? And then I have to go through this huge body of evidence that nobody wants to sit through, right? So if I just come in and I plainly state what happens, it sounds ridiculous, right? Just know what's going to happen. That sounds ridiculous, right? Oh yeah, if it was so easy to just know. Yeah, no, you can literally know. Guys, that CPI, the expectation was 0.5. It came in at 0.3. At that point, that instant, you know what is going to happen for the next 30 minutes, if not rest of the day. You might not be able to trade on it. In this situation, we weren't really able to trade on it. We only made 15 bucks, okay? But you know what's going to happen. And there are plenty of other situations where there is information that is available, publicly available, that can be just as predictive, and like people are clueless and they don't know. It happens all the time, okay? The beginning of this year, we knew that the Federal Reserve was going to start raising interest rates and that the rates were going to have to go substantially higher. And everybody in the equity markets was, and I was telling people on TikTok, like, your tech stocks are going to get crushed. And everybody just kind of sat around like, had no clue. They had no clue, right? It was an informational inefficiency. You can find them all the time. So it really is as simple as know what's going to happen, right? Sometimes you think you know what's going to happen and you are wrong. That happens. Hey, that's kind of like the flaw in the strategy, is that you've got to be good enough at knowing your limitations and where you're wrong and so forth to be able to pull back. Like, I know in this kind of a day that like it's probably going to keep going higher, but I got to be really careful about taking a trade because you get these really crazy pullbacks and you lose money from them, right? Okay. But it really is as simple as know what's going to happen. If they're going to move up, then you want to buy it first. And if they're going to move down, you want to sell it. It's that simple. Right? But it sounds ridiculous when you say it. It sounds ridiculous to anybody that's a trader when you say it, but it really is like that simple. And that's why so few traders ever actually figure it out, is because they make it more complicated than it needs to be. They think that there needs to be some sophisticated pattern combination of all of my indicators and price action that I'm seeing. And I think we run into this with order flow too, is like the beginning of my trading, you go back and you look at my streams from 5 years ago, and listen, markets are complicated. So there's some real benefits to making things complicated. But the problem is that I knew the main answers because the traders at the bank had told me, and I didn't understand it enough to like really trust it, I guess, or really be able to apply it correctly all the time. Right? Is this still stream beats? Yeah, okay. I was just like, this is totally like an anime style track. But who knew where CPI was going to come in at ahead of time? Well, you don't know ahead of time. You don't take that trade before it. You take that trade after the number comes out, right? So this is where, again, there's a lot of math and complicated stuff where we arrive at that conclusion. That's the kind of thing, is that like the empirical data has basically come to a conclusion that very much contradicts technical analysis, right? Because what does technical analysis say? Technical analysis kind of adheres to the weak form efficient market hypothesis. Okay. So the weak form efficient market hypothesis says that the market prices in like past market information in past days and everything like that, but that it doesn't necessarily price in everything that insiders know and things like that. And so technical analysis traders think that I'm looking for a trend on a chart or some other pattern that suggests that somebody big is buying and that it's going to rise in the future. That's the way that the technical analysis people think it works. And so the technical analysis kind of approach to it would be, okay, if CPI comes out and then the instant that CPI comes out and is known to the rest of the market, it is now priced in, or that it gets priced in very quickly and that it's not worth trying to trade or to make money on it, right? Okay. Well, the reality is what we've learned from market microstructure is that the orders are what moves the market. And there may be a price that is a fair price based on all available information. But guess what? We number one, we don't really know exactly what that number is per se. Not everybody has all of the information. And it's ultimately the orders that move the market and not the fundamentals. So it doesn't work like, oh, okay, we should be at 3.75. No, it doesn't work that way. The way that it works is people's expectations have been changed, and so X thousand orders are going to come out. And the number of orders that are out there and the current liquidity conditions are 100% predictive of how far it ends up going. They've done studies about this every time, that the degree of a move is perfectly correlated with the volume that trades it, with the volume and the liquidity conditions. And if you go after the fact and you say, this is what it started with, this is what the liquidity was, and this is how many orders went in and traded it, and you can calculate exactly how much it moved every time. And the fundamentals don't predict. You can't do that with the fundamentals to predict the price. It always comes up short or long. It doesn't go enough or it goes too much, because that's not what's actually moving the market. The orders are what's moving the market, right? Right? So that's where we come to, okay, so does that mean, what does that mean? That means that when CPI comes out, you could get good trades all day, potentially. Usually it doesn't work out that way in the treasury, but you're and at least for a few hours, yeah, you're gonna get good trades. And I think that it could be the case that the S&P 500 continues to move up beyond 3,900. Like you guys were talking about 4,000. I think that's a good spot to look for. The flaw is to think that everything that is not information is TA. I'm not sure I understand what you mean. Let's read the rest of this. And not all OF. What is that? Are we talking about OnlyFans now, Lucas? Is based off of pattern trading, which is basically the definition of what TA does. Okay, so there's this issue with the definition of TA, right? So when I said like this is the technical analysis approach of things, what I'm really saying is this is what technical analysis is based on the technical analysis of stock trends, the book, right? People turn all sorts of things into this is technical analysis and this isn't technical analysis and stuff like that. Like people say that price action is not technical analysis, but it is, right? So it's like we kind of have to use a different set of terms to make sure that we perfectly understand each other, right? So you would say it's pattern trading. We need to be more specific than that. right? If we were to say it is trading off of a past prices, right? So when we're talking about pattern trading, what we're saying is I have a single time price data series, and I'm using the information that I can glean from that single time price data series to make my decisions, right? And that would be, you know, you could say price, yeah. One person, that might be considered technical analysis, right? But I'm trying to give it a little bit more narrow or specific of a definition. And then once we have a little bit more specific of a definition, then we can kind of look at the problems with it, right? So what are the problems with it? Well, the majority of the actual movement in price outside of what's going on in the order flow is random. And a move of on a 1 minute chart of a certain pattern or a breach of a certain price based on past prices is not very effective at predicting the next set of flows, basically, right? It could have been. Maybe it was possible. Like I like the theory. The theory all seems like sound like, oh, everybody will see. Okay, so Fibonacci's levels get respected. Yeah, everybody thinks that this price matters, and so people are going to sell there and it's going to hold it, right? Seems like it makes sense. It's like a good theory. It's just that none of the empirical data has ever backed any of that stuff. At least not in respect to that it can lead to profits. So like Fibonacci levels get respected. What I've found is that if you've got a level, and I think that even numbers are the biggest ones, like 3,900. Even levels are the biggest ones. Daily moving averages are the next biggest ones. So like 50, 100, and 200 day moving averages, right? The third one would be percentages. So like 10% decline from all-time high, 20% decline from all-time high, right? And then after that, I would say Fibonacci levels, right? These are levels that there is abnormal behavior around, but from all of the research that I've done about this, what that ends up being is that the action just ends up being that much more random around that place. That you'll come to the price level and there will be a lot of really bizarre random rotation around it as people fight over it, right? Like so this comes back to this thing, which is like, okay, so say I'm expecting an order flow to come in, right? And then I wait, and then I see that order flow come in, right? Well, if I see just like a teeny tiny little confirmation that it's coming in, and there's still going to be tons more coming in, like I'm expecting there to be a 50,000 climb in cumulative delta, and I've already seen 10,000 of it. Okay, maybe I can justify going long if I think that I'm going to get a good price, and like everything else, like my risk management is right, which it wasn't today, right? Which is why we only took one trade. Then I can take a trade. But if I've already seen 50,000 contracts come through, then I don't have a trade, right? Because it already happens. It already happened, right? Everything based off past information is based off patterns. That's what it really comes down to. I don't. Okay, sure. Okay, so let's talk about past information. Okay, what can past information tell us? Okay, the one thing that is well proven that we can glean from past information is the information that is basically used to trade options. Okay, so volatility tends to cluster, and volatility is path dependent, which means that the past movement of the index and whether it moved up or down has an impact on what the volatility is going to be today, right? It's not 100%. So for instance, that path dependency doesn't predict that it was going to move 2.5 to 5% today. You'd have to know that it was CPI today to know that, right? But about 70% of volatility can be explained with the past movement. And I don't like to call it a pattern, because it's like a complicated calculation that's much more sophisticated than a pattern. You know, it's not something that you're going to see just from looking at a chart. That's why I don't like to use the word pattern. But past market data, past price data can predict about 70% of volatility. But guess what? Doesn't predict direction very well. So you know that it's going to move a certain amount, but you don't necessarily know which way it's going to move. So you're a fan of ATR, meaning if the move has met the ATR early in trading, then there is no trade. So I definitely would recommend keeping track of ATR. If there's an indicator that's worth looking at, it's those big moving averages followed by ATR. But I wouldn't say that like, oh, if we've already reached the ATR early in trading, then there's no trade. I don't think that that's accurate. ATR is average true range. So basically looking at the average of the volatility over the last 14 days is a pretty decent indication of what the volatility is likely to be today. It's just ATR is like the most simple approach to it, right? There's a study that's come out the last 6 months that used machine learning in a matrix to sort out how these things factor in. That's much more effective at doing it. And it basically takes into account all past prices, but it weights them. So more recent moves are more heavily weighted. And then down moves are weighted differently from up moves. No, not basically look to trade back to the mean. It's just we're saying, yeah, good luck with tail events. It's like it doesn't trading that on its own doesn't result in profitable trading. So I was saying, like, you probably want to know what the volatility is likely to be. So like I can come in here and I can be like, okay, nothing's happening today. You know, let's say that it was yesterday. Okay, let's say that it was yesterday. We can come in and like, well, there's no major news. Nothing's happening today. We have a big piece of news tomorrow. So, you know, this is what the ATR is. And we're probably likely to be a little bit below that. Right? So if I'm having an up move and we're like at the extent of the ATR, it doesn't really make sense to try and take a trade at that point, does it? But then at that point, you'd also have to ask yourself, what piece of information do I have that's going to predict an order flow? Well, I don't have one, so I'm not going to take a trade, right? Yeah, what is, let me come back here. So I'll show you. So this is one of the indicators that's included in my indicator NinjaTrader 8 indicator package. It's just this ATR down at the bottom. It's just a little bit more fancy ATR that will show me the individual daily ranges in addition to the average. And it also allows me to change it so that I can look at it in terms of percent. I believe I have it set to percent. Let me double check here. Pretty sure on ES I have it set to percent. Multi-ATR percent. Okay. So it's saying that the average volatility lately has been 2.67%, right? That's, and then we moved 4.47, right? But that's how the options traders do it though, right? Is they come in and they say, okay, this is what my models say volatility should be. This is what the market says volatility should be. And maybe I have a model that predicts volatility a little bit better, so I can choose to buy or sell options based on that. But then I also have to understand what's going on in the market to say, well, but I got to be careful about that CPI day, right? Because the model's not going to be able to account for that, right? So from that perspective, like if the argument was past prices are not very effective at predicting future direction, therefore we shouldn't look at prices at all, that wouldn't be true, because there is some informational content that can be gleaned out of it. It's just that it's not enough to give you a consistent edge, right? I'd rather have it modeled based off of volume, which determines volatility. Yeah, you could probably try and do it based off of volume. I think that would be super hard though, because like the liquidity can change, right? And probably a small change in liquidity would have a really big impact on your volatility. That makes sense. So like today, we're putting up a little bit less than 1,000. We've gone really far. What you're talking about, Lucas, would be really good for like day trading, right? And it's something that I think in order flow kind of tend to do unconsciously, is we can just see how quickly it's trading through prices. I'm not necessarily looking, oh, it's 1,000, so that means it's gonna be able to move to here, but you get a feel for how quickly it's trading through that liquidity, and therefore how long the moves are going to be and stuff, right? Okay, so Trojan scopes. The way that you got to approach this sort of a thing is, okay, so 50% fib, for instance, okay? So if we are below the 50% fib and we're coming up into it, I want to sell it. And if we're above it and we're coming down into it, I want to buy it, expecting it to bounce off of the fib, right? And I need to program that and run it over, 30 years of data or whatever, until I have a couple thousand data samples and then see what the behavior is, right? I can't just look at one chart and say, well, it did it this one time, that must mean it works. Right? That's the problem with all of this price action stuff and everything, is like price action setups. You will find regimes where it works really, really well, but then when you look at it over a large enough time frame and you look at it from the perspective of a trading strategy, it's not a profitable trading strategy because the tails are fat. When it doesn't work, it just gets destroyed, right? Too many variables? No. There's no such thing. There's no such thing. So here's a question for you. If the Fibonacci level itself has an advantage to it, why does it need a trillion other things in confluence with it to be meaningful? Right? If the Fibonacci level itself has edge in and of itself, I should be able to tease that out of a large data sample, right? Like I should be able to come in and be like, run it on 100 years worth of data and see that they bounce off of the Fibonacci level 52% of the time. And then we've quantified the edge there, right? And over a large enough data set to get a 2% change, that's, maybe that's statistically significant. I don't know if you'd be able to make very much money off of it, but 2% would be statistically significant, right? But if it needs all of these other variables, how do you know that it's the Fibonacci and not like one of the other confounding variables, right? And to that point, how do you know that all of those variables together really actually results in a profitable strategy, right? Do you actually know? Can you actually prove that? Because what most people are doing is they're saying, well, there's this one guy and he had success with it, right? Or I've been trading it and I've had success with it. But the reality is that over the past 10 years, you don't actually know how it performs, especially if you think that there's too many variables to program it. But the reality is that if it's purely technical, you can backtest it, right? You shouldn't really have problems backtesting something until you get into incorporating information that is not available just from looking at past market prices. If everything that you're using to make your decision is based on past market prices, then it is programmable. You just might not have the expertise to program it, right? And this is where it kind of gets into interesting stuff, because like for price, these things are very readily back tested, and that's why so much of technical analysis has basically been thrown down the drain the past 20 years, because people learned how to back test it and they found out that, oh, actually it doesn't actually work. Right? Order flow is like technical analysis of order flow is kind of in a slightly different situation, because retail traders don't get good enough data to perform that level of an analysis reliably. My own studies kind of show that it goes in regimes. It'll work really, really well for a quarter, and then it will work terrible for a quarter. So maybe there's a Markov system below it that you could utilize that could help you there. So I kind of have a little bit of hope for some of those technical patterns, but then what I do, and I come in and I say, well, CPI is 0.3 versus an expected 0.5. Can't program that. I'd need a machine learning algorithm that can read the tweets and can see what the difference was. I'd need or I'd need like an API that's giving me the economic data. I have to know like what the past ones, how big of a change it is, and I'd have to be able to understand that this particular CPI is particularly important and all these sorts of things. You know, like once you start to get into the more informational inefficiencies, those are feasibly programmable, but it's very difficult. And I think the reason why we as humans can still find an advantage in that is because they can't really effectively program those yet. There's some things that you just know, and there's no way of pointing out what that is or explain it or put it in, well, 100%. But here's my contention. How do you know that those things aren't the informational inefficiencies that I'm talking about? Right? It's like, because this is like this went through this with John all the time, because he would make these trades that was like, wow, that was a really good trade. How did you know that was going to happen? Like, that totally contradicted everything that you told me about the technicals. And it was like, well, I just knew. But he knew what was going on in the market. He knew. He claimed that he wasn't paying attention to it, but he knew more about what was going on in the market than I did most of the time. Right? So how could he say that he wasn't? In fact, how did he know that wasn't what was giving him the edge? You know? Oh, the problem with programming a bot, I find, is that I can, just by looking at the DOM, know it's going up or down, and I don't know at all how I know this. I cannot explain it, let alone program it. Yeah, but I'm telling you, I do the same thing, Lucas, right? Like the trade that I took yesterday, right? I was like, this is screaming buy as she goes, right? I know the setup, right? But I also know that setup is 50-50. So why am I so confident that it's going to come through this time? Because there's a big order ahead of us and we're close to an even number, and there's momentum with it. But like, certainly I've seen times like that too where it didn't work out. And how did I know that in that particular time that it was actually really well is going to work out? Well, maybe I'm crazy. Well, not that I'm crazy, but maybe it's just a mirage. Maybe I really, I thought I saw something, and because it worked, my brain remembers that as something that really works. But until I've been able to find 10,000 other situations exactly like that, how would I know that I would actually interpret it as that every time, and that I'm actually really seeing something, and that it's not just confirmation bias? right? That's the first thing. And then the second thing is, how do we know that I wasn't getting that as a subconscious interpretation of what I knew about markets at that time, right? So my subconscious could be looking at everything that I know about the markets and using informational inefficiency to determine that it's going to continue to move up, and I don't even realize it, right? It just kind of comes down to like, is it just easier to wait for a massive crash and then go all in and wait a couple of years? Well, yeah. Listen. So, Slayer. It depends on what your objective is, right? So if your objective is to be as involved as possible in the markets, then futures trading is for you. That's really what I think the reason to trade futures is, because you want to be involved in markets. You want to know what's going on, right? If your goal is capital appreciation, don't trade futures. Okay. So capital appreciation means I have a lot of cash and I want to get the highest return for that cash that I possibly can. If your goal is capital appreciation, don't day trade, don't do futures. Okay. You might be able to be profitable from futures trading, but if you're profitable from day trading, you're probably making less money than you would if you just like bought and hold or something like that. So yeah, is it easier to just wait for a massive crash and then go all in? Yeah. In fact, it's easier to just regularly put a certain amount of money away in your tax advantaged accounts. Oh, you know what? It's 9 o'clock. I gotta get going, guys. Didn't even realize. Okay. I will see you guys tomorrow. We can continue this conversation. In the meantime, stay excellent, team.